Hey guys, so today we're going to step through this euro-dollar trade. It gave us a positive 7-hour win, and we closed it out a couple of days earlier this week. This is really our bread and butter trades at Method Trading. They're really simple. We have 4 steps that we go through to set them up. These are really easy, simple trades, especially if you don't have a lot of time on your hands, if you've still got a day job and you want a kind of an easy way to look, know if there's a trade, follow a couple of steps, and then set and forget. So let's head to the chart and see how we set the trade up. And first thing first, the first step is our direction, our bias. So we're here on the 3-day chart, and as you can see, we've got a recent break of the structure. This range was actually, we were in it for a couple of years, and we've been trading this range till recently when we broke out. And at that point, we've gone to the left-hand side of the chart and we've looked at the wider structure. So this very long range down here that happened in 2021 it has become our directional bias range. So placing our fib at the top of that range down to the bottom, we have actually had that break at the 61.8% level. This was also the level that obviously contained the range for so long. So it's a really key level, and we've been trading shorts every time we get up here. But obviously we had this breakout. It confirmed our bias to continue long. So we didn't change our bias to shorts. And we're now trading longs off this new bias, which means our phase that we're trading is the 61.8%. I go through how we create our bias and determine it and give our trading context in my Method Trading starter strategy. There's a link below if you want to have a look at that. But the important piece here is that this gives us our direction. We are long, and this is the basis for it. We also, at this point, look at targets. So we can see here we had an initial target which actually played into this initial confirming the break, and then we're actually trading 61.8 trades. So in our phases, up until this point, it's a run trade, and we're now changing to phase 61.8%, where we expect, because we've broken this level, we expect it to go back, retest, and then we've got new targets up higher. So our ultimate target is this grey level. But when we've got a huge range like this, we've got to consider that there's quite important levels here. There's a lot of levels that price has to push through, and all of these levels create resistance on our way up. It's the same as this level here, which we've now, we've got a little positive sign there that we've broken it. So it confirms our break and our bias. But before that, if we looked at kind of a wider structure of that, we were hampered here for 2 years where we got to this level and it formed resistance and it pushed us back down. Okay, so breaking these levels is really important for us to have confidence that the bullish case is still in play. But secondly, we need to consider that we may be seeing some resistance, and this was resistance for a good 2 years. So we want to make sure that when we get to these resistance zones, that we're assessing whether it's time to take some profits and see whether that zone really is a resistance or whether we're going to continue through it all the way up to the top. So we could go all the way to the top. We could take a little while to get there. But the important thing is that these are levels where we're not expecting price to turn around midway without taking out a level or taking liquidity from a level. That's the basis of our trading. So the short point here is that this level here has been taken out. Okay, it's no longer, it was an initial target, so it's no longer a level for us. And then we've got to look at the next level. And because this is such a long range, We place our pullback finder. There's quite a lot going on even on the 3-day, which is normally our bias determining time frame. So on this, we're actually going to go to the 1 week, up one for us, and we're going to look at what's important. So we can see here that this level was taken out, traded into this level, and there's actually a level above there, which is this little white candle up here. And that's the liquidity we're looking to target here. Okay, so now we've got our bias. We're going to go on to step 2, which is looking at the 1-day event. So this is us going back to the 1-day chart. Here's that target we took out on the way to retesting the 61.8. That's all happened. Our bias is long. We had earlier trades throughout here, but the trade I'm going to look at now is this latest one that happened on the 12th of June. Okay, so actually 1 day over. I'm just going to ignore that. Okay, when the 12th of June started, the previous day's candle had closed, and that's the point we look at. Do we have a setup? We're a long bias, so on the 1-day trigger event, we're looking at a pullback, which is, it's helpful to see these red dots to confirm that we've got a pullback, and then we look for green dot. So red dot, green dot when we're trading long, as you know if you've done the starter strategy course. And we've got a valid entry. This let's just put we determined this to be a supply and demand zone. It's a demand zone, but we call them interchangeably. Okay, so we've got the 1-day S&D, supply and demand zone. Where has it happened? It's taking place inside, it's tapped inside a previous down trend. We call these method blocks, or it's just a retrace where liquidity is. So liquidity could be in this entire block. It could be just inside these 2 candles that formed our previous S&D. Now we've actually tapped into this wider structure as well as just the tip of that S&D, which makes this a valid supply zone. And we've also it's closed not inside another S&D. So if you go through the strategy, you'll understand those 2 scenarios that invalidate a setup. This setup is valid, so that's great. We've got our 1-day event. Now we're going to, from here, place our entries. So step 3 is placing our entries. And it's that simple. We don't look at any more analysis beyond this at this point. Okay, so we're going to put our trade up there. As you know, you place this block on the body of your break candle, and then we place the entry at 50% as the default, and the stop loss goes at the opening of this candle. Okay, now as part of placing our entries, this is just the default entry. We want to just look if there aren't any sensible adjustments that we need to make. So to do that, we go down to the 4-hour. And what we're looking for here is the last supply and demand zone on the 4-hour. So we're looking for a demand zone, and it's these 2 candles here, red dot, green dot. So we want to place a box around those 2 candles. Okay, now our entry cannot be less than 50%, and our entry already takes this into account. So we're quite conservative on our entry, which is great. We don't want to move our entry so far into this zone, which it could happen, but we could also miss the trade. You're going to get a way greater RR on the trade, but you're going to miss a lot of trades. We don't want to be missing trades. We want to be in trades. So our entry is fine. There's no adjustment allowed on that. But our stop loss will be adjusted to take into account this S&D here. So what we're actually doing, instead of using the body of the daily, this will actually move to the wick. So we are going to adjust our stop loss, and it gives us actually a 491, or it's actually 49 pips stop loss or sizing. We want to do one more adjustment. We want to go down to the 1 hour. And we're again going to just look at this last S&D, this is the last push down. And our entry is fine, and our stop loss takes that into account. So if we were being very, very aggressive traders, we can identify this little zone here and move our entry and our stop loss there. My back testing has shown that while this gives you great returns, you also have a lot more losses and you have a lot more missed trades. So it really depends on where you're at in your trading life. How good are you for lots of losses, lots of missed trades, but when you do get a trade, it's a great trade? Or would you rather kind of consistently be in trades and have them be profitable? So that's up to you. Those are decisions you need to make as a trader. Right, so we've got no adjustments to make on the 1 hour. Perfect. So we're going to go back to the daily. That's step 3 done. Step 4 is we want to just check that target, which we've already established during our, we don't have to do any analysis here. We've already established this target. And we want to trade to there. Okay. And our target is set. And Dunsky, we then let this trade play out. So we're tapped in a couple of times and out. Really nice, easy trade, set and forget. This is really our bread and butter on our method trading strategy. We then have advanced entries, advanced trades, but we trade these all the time because it gives us our bread and butter. Last month we had 20 RR, and it's really with the least amount of work for a great result at the end. Sometimes over trading can lead to pretty bad losses because the effect of many losses, many missed trades can have a big impact on you. So sometimes simple is the best way to actually just slowly, consistently build up profits. And that's really the principle that we trade on here at Method Trading. So I hope you enjoyed that.